I'm going to, excuse me, write down a heading, which is the title of the chapter, Transmission Mechanisms of Monetary Policy. Let me back up a bit. Sophia was asking if chapter 25 will be on the exam and why, and because it wasn't the course outline. There's a good reason for this. Remember that normally, and by normally I mean not this academic year, normally one of our classes we don't spend in class. Normally one of our classes we will go to the Fed. Normally we would go and spend a class in the boardroom of the Fed, and someone from the Fed would talk to us and explain what they think about monetary policy in the past, going forward. We would ask them questions about anything, mainly monetary policy. And of course we couldn't do that because the Fed's visiting program is shut down because the Fed is entirely operating online. I know several people at the Fed, they're working from home just like I am. So we can't visit. It's a shame because normally we would go and sit in the boardroom where the monetary policy decisions are actually made. But so as a result, that means I had to create a new topic, and I decided this was a good one because I feel like maybe we neglected a little bit some of the transition mechanisms of monetary policy. And I guess I should start by mentioning the first one, which the text refers to as the traditional interest rates channel, which is what we've been thinking of as being the main way in which monetary policy affects aggregate demand. And how does that work? Well, as discussed, we know that by various ways, the Fed can lower the nominal interest rates. And lowering nominal interest rates, of course, doesn't necessarily do anything because ultimately what we care about are real interest rates. So the key thing for this to work must be that lowering nominal interest rates also lowers real interest rates. And so we have that, right? The prices of goods and services, the inflation is what separates these two things. And the inflation doesn't necessarily change immediately. And of course, if interest rates are lower, it makes it cheaper to borrow. So unsurprisingly, what this would do is to stimulate borrowing. Now, of course, in order for this, or indeed anything else, to have an impact on aggregate demand, it would have to stimulate one or other of the components of aggregate demand. So the key is to remember that, of course, people don't just borrow for fun. If you borrow, it's because you have something that you need to do or want to do that's beneficial or profitable, and you don't have the cash to do it. And of course, we should remember when we talked about aggregate demand that borrowing is one of the many key, the ability to borrow, and of course that's the price of borrowing, is among the key determinants of two things. Two of these items here. One of them is business spending. If you want to expand your business, chances are it's worth borrowing in order to do it. And so the ability to borrow and the cost of borrowing is a key determinant of business investment. Of course, businesses aren't the only people who borrow, and thus they're not the only entities that are sensitive to interest rates. People like you and me are also funding some of our consumption by borrowing, right, through credit cards or other forms of borrowing. Also, when people buy vehicles, they're often borrowing because on the durable goods like vehicles, they last a long time. So one, instead of just buying them with cash, most of the time people don't buy them with cash. Most of the time they borrow and gradually pay off the value of the vehicle over the course of its life. The same with household durables like refrigerators or even houses themselves, for that matter. So by lowering interest rates, this channel of monetary policy can stimulate investment or consumption by encouraging more borrowing, by making it cheaper. Okay? So that's, again, the traditional interest rate channel, and that's how I think most people think of monetary policy and how we've been mainly thinking about it so far. Okay? And of course, if there's an entire chapter on this subject, that means that this isn't the end of the story. So now imagine the following scenario. Suppose there were no monetary policy. So suppose we've fallen into a recession. So the aggregate demand curve is over here. If the Fed does nothing, then inflation, remember this is aggregate demand, this is real GDP, right? Inflation is lower than we originally anticipated, and now we're stuck in this position. Once we see the Fed act, we see the Fed using its monetary policy, that tells us, oh, demand curve is going to move this way. So instead of having this level of inflation here, we'll more quickly get back to what was originally anticipated, right? And so what does that do? That means that the inflation rates we expect to be around should increase, given that we know that the Fed is going to intervene. Instead of being stuck here, we may return there more quickly. So expectations of inflation should rise. Now, why does expectations of inflation rising turn out to be a transmission mechanism of monetary policy? Well, remember that real rates are the nominal rates minus inflation. If you believe there's going to be higher inflation, then if you borrowed already, i.e., let's say you borrowed to buy a car, and so you've agreed that you're going to pay, I don't know, 7% interest per year on this car. If you suddenly think inflation is actually going to be higher than originally, that lowers the real burden of your debt. So what this does, when the Fed acts and affects what you expect to happen to inflation over the duration of this recession, what it makes is outstanding debts less burdensome. Of course, if you don't owe as much money, that may stimulate your consumption or investments, for that matter, if you're a firm rather than an individual. So this is distinct from the first channel because the first one involves making borrowing cheaper, which thus stimulates more spending. that's financed by new borrowing. So this thing here is about new borrowing, whereas this one is about the impact on the burden of previously existing loans, making them a little lighter, and thus freeing up funds for further spending. So that's why these two are a bit different. Okay? So far we focused on interest rates that directly or indirectly stimulate consumption or stimulate investment. There's a good question to ask, which is, are there any other things are there any other elements of aggregate demand that could be affected by interest rates? So to think about that, let's think about the following. Suppose that we're in a recession and the Fed responds by lowering interest rates. Is there anything that would do that might affect any of these other elements of spending? Now, government spending is a whole separate thing. It's determined by governments. It's fiscal policy, so we'll ignore that. The question then becomes, is there any way in which lowering interest rates might affect net exports? Now, to affect net exports, you would need to have something that changes the price of goods at home relative to the price of goods abroad. And what is the key determinant of that? Well, it's the exchange rate. So, would changing the interest rates have any impact on the exchange rate? Of course, the answer is yes. We know from discussing exchange rate determination that one of the key determinants, I guess the most important, the largest volume of transactions in currency markets has to do with investors who are trying to chase the highest rate of return across borders. And if you lower US interest rates, what did you just do? You lowered the return to investing in the US, at least in US bonds. So people would want to buy fewer US bonds, which means they want to buy fewer US dollars, which means the value of the US dollar should decline. What does it have to do with net exports? Well, net exports has two parts, imports and exports. If the US dollar becomes cheaper, what did we just do to US goods? The US made them cheaper relative to foreign goods. Alternatively, we just made foreign goods more expensive relative to US goods. So if foreigners observe the US dollar losing value, what does it mean? It means US goods lost value. So their demand for exports of goods out from the US should go up. What about people here? Same thing. They observe the US dollar losing value. It's the same thing as the foreign goods foreign currency gain value. So suddenly foreign goods look more expensive. So we should observe that imports decline. Of course, net exports is exports minus imports. Exports go up, imports decline. On both counts, we have that net exports should increase. So this gives us a third channel, and this one, again, doesn't involve consumption and investment. It's this indirect impact that the interest rate change might have on the value of the US dollar. Or more generally, the value of the domestic currency. Okay? Any questions about this? Now, of course, this third channel here might not be so important for the US because the US has a relatively closed economy, as opposed to some countries that depend much more on imports and exports. Like imports and exports are a much bigger part of their part of their aggregate demand. For those places, these channels might be much more important. Okay? Now, these are sort of, I would call them more or less direct things that are affected more or less directly by interest rates, but there are others that are affected more indirectly. So next we'll think about those. And again, I'm going to start by reminding ourselves of what are the components of aggregate demand. Oops. But always in sight. The next thing is to think about, so far I've been thinking about borrowing as a determinant of spending. And then we also thought about exports and imports. But remember, the determinants of spending have, borrowing is not, of course, the only determinant of spending. Aside from your ability to borrow and the cost of borrowing, and aside from your current income, there is a third source. There's a third factor that determines your spending, and that is your wealth. Right? The value of the assets that you hold, whether it's financial assets like shares or bonds, or whether it's your house. Housing is a big chunk of the wealth of most houses. And you might wonder, well, how does a change in the value of my house affect my spending patterns? Well, it does, because it affects your ability to borrow. You can borrow against your house in order to pay for other things, whether it's renovations or whether it's college for your kids or anything. So the value of your wealth, whether it's shares or housing, can also affect your spending behavior. I remember in the year, was it 2000 or 1999, around then, the stock market, which is one form of wealth, rose so much that the savings rate was negative. Like, people were spending more than they had income. How come? Because their wealth was so high. Didn't last, but anyway. So let's think about wealth, and I guess I just came up with two examples of wealth effects. One is that if interest rates drop, you're making it, we just discussed that it makes it easier for companies to borrow in various ways. And it also stimulates exports and spending, so of course the companies are doing better. And that means, of course, that the future prospects of these companies are improving, as well as their current prospects, which means they're more likely to provide income to their shareholders. Then we know what that means, right? Because the value of shares is connected to how much income you expect to earn from the company. So the companies are doing better, finding it cheaper to borrow, and so on. That means share prices should rise. As discussed, although not everyone owns shares, it is a factor of wealth of many people. And so when share prices rise, overall, wealth increases, this factor of wealth. And of course, that means that, as discussed, people are able to consume more, because they can either spend their new wealth, or again, it just means that you have something to fall back on, and so you may spend more out of your income. Okay, and then there was the fifth one. Let's go to the fifth one in a sec. Investment increases too, along with consumption, right? I guess if you're thinking about the wealth of a company, you could. right? If the company owns financial assets of some kind, they increase in value, then it might free up the company from some financial frictions. So, in principle, yes. The fifth one was that, as we were discussing, the main factor of wealth for most people is the house they live in, for most households at least. And so let's think about what the impact of monetary policy might be on housing markets. Now, if you make interest rates lower, well, how does the housing market work? Most people, when they buy houses, well, they don't pay cash up front. Of course, that makes sense since houses are an extremely large expense. It's beyond the means of most people to just buy up front. Rather, what happens when you buy a house is you generally take out a mortgage, which is just a loan that you use to buy the house. When you're lowering rates here, you're making it cheaper to take out mortgages, which means that you're stimulating people to go and buy houses. Now, if more people buy houses, what does that do to the housing market? Well, in general, increase the demand for anything, you'll get the price to increase. So, one of the things that monetary policy does is raise house prices. Let's see, just 1 second. Marshall, increase prices, that's right. So, why does that matter? Well, think of someone like me. I'm not interested in buying a house right now, nor in selling it, but because of the low interest rates right now, demand for housing in general has increased, which means that the price of my house has increased. It's actually quite ridiculous. I think my house, according to Zillow, my house gained $200,000 in value over the past year. I'm pretty sure that's in no small part due to the extremely low interest rates. There's also a demand for suburban housing because people are trying to move out of cities, but no small part of it is due to the Fed's actions. And of course, this house that I'm sitting in is probably the main factor of my wealth. And again, that makes it easier for me to consume. For example, I could be, as I discussed, it's not unusual for people to take out second mortgages. Maybe you've already paid off a big chunk of your mortgage, but you decide, you know what, I'm going to use the house as collateral to take out another loan. What for? Again, maybe to renovate some part of the house, or to buy a car, or to send someone to college. They're all sorts, or just to go traveling. Not that I do that much these days. In all those ways, your increased housing wealth can stimulate consumption. And Sophia was saying, well, could it stimulate investment as well? I guess yes, because what if the value of commercial real estate rises, and I am a company that owns the building that I operate in? Then if that goes up, then it's also increasing the wealth of the company. Okay. Now, the next wealth effect that the textbook mentions refers to a concept that financial economists like to think about a lot, but it doesn't crop up that much in economics in general. And that has to do with the following. All of this time we've been thinking, well, suppose that something happens that means that you have a valuable investment project, then the business is going to pursue it by increasing investment. Right? We kind of made that assumption. But in a way, that's not true, right? If I wanted to increase if I wanted to increase the size of my business, maybe because I want to move into a new line of business, or I just want to expand what I'm doing already, I don't necessarily have to buy new capital goods. I don't necessarily have to increase investments. What's my alternative? My alternative would be to buy investment goods that already exist. Say maybe there's a company that's selling some equipment. Instead of increasing investment by buying new equipment, I could buy second-hand equipment. Or maybe even more importantly, which I'm not sure which is more important, but another way of thinking about this is if I wanted to expand my business, instead of buying new investment goods, I would just buy a company that already operates in that area. It's called mergers and acquisitions. So that's, for example, a few years ago when Amazon decided that they wanted to move into the grocery business, did they set up a new chain of grocery stores? No. They bought Whole Foods. And now Whole Foods is part of Amazon. So what does that suggest? It raises the question of whether of how monetary policy affects that decision, the decision to expand by new investments or to expand by acquiring pre-existing capital. And that's related to a concept that's known as Tobin's Q, excuse me, which is defined simply as the share price divided by the cost of the machinery, equipment, and other forms of capital that a company owns. Okay? If Tobin's Q goes up, it means that a company is very valuable relative to the underlying machinery that makes it. Right? If Tobin's Q goes down, it means the opposite. It means the company isn't worth that much compared to the machinery that it owns. So if Tobin's Q goes up, it means it's expensive to acquire a pre-existing company relative to what you get from it, which is the machinery. If Tobin's Q goes down, it's indicating that it's cheap, because the share price is what you need to pay for a company, right? But this is what you get, machinery. So if Tobin's Q goes down, the company is cheap and easy to acquire. And so it becomes a more attractive way of replacing your machinery or expanding your business instead of new investments. So what does the Fed's monetary policy do if it's trying to stimulate the economy by lowering interest rates? What does it do to Tobin's Q? Well, we just saw it raises share prices. So this goes up. At least the denominator goes up. The numerator, well, it's just the cost of replacing some machinery. That's not affected by monetary policy. It's just affected by supply and demand of the machinery. So this thing goes up. This thing doesn't do much, so Tobin's Q goes up. So what's Tobin's Q again? It's the cost of investing in pre-existing capital. So if Tobin's Q goes up, then the interest in expanding by buying pre-existing firms should go down, which means that if companies are trying to expand their businesses, Tobin's Q going up means they're more likely to expand by extra investment, than they are to try and expand by acquiring pre-existing capital. Sorry about that. Something happened to my chair. All right. So that's another thing that the textbook emphasizes. Any questions, comments? Although I should say that these are all factors, all 6 of these channels, that either directly or indirectly have to do with interest rates. So, just a second. M&A means mergers and acquisitions. The idea that you expand your business by buying another firm, merging with them, or acquiring them. Okay. As opposed to what? As opposed to new investment, which is part of spending. So all of these 6 things we talked about are directly or indirectly due to the impact of interest rate changes. And remember, I was discussing early on today and also last week that suggests that monetary policy might have its limits, and that limit would be the zero lower bound, right? Because once we get to 0 interest rates, we can't really go any lower. So I want to take a little pause to remind ourselves of what are the problems that might emanate once we hit the 0 lower bound. And then once we're done with that, we'll continue by seeing, are there any other ways in which monetary policy might work even once we've hit the 0 lower bound? Okay? So I'm going to remind us, I guess, of how it is that the text tries to represent the 0 lower bound in our theoretical framework. And I also want to show you something that I think I may have skipped over last time about how when we hit the 0 lower bound, things can get pretty complicated. Excuse me. So the way the textbook represents the 0 lower bound is by saying that, as we know, normally lower inflation means an increased spending power, which is why the aggregate demand curve slopes down. However, if inflation is too low, this negative relationship may no longer hold. How so? We discussed this in 2 ways. One was, I brought it up by referring to our discussion of financial crises, where if inflation is too low, you end up with this phenomenon called debt deflation, which is that you'll remember, actually, why don't I just write this out? This is the definition of real interest rates. If inflation keeps ending up being really low, for any loans you already took out, because loans you already took out already have an interest rate that you agreed on, what that's doing is raising the real rate. In other words, it's raising the real cost to you of servicing any loans you took out. So if inflation gets low enough, then people may start defaulting on their outstanding debt, which means their wealth starts getting destroyed, which means that if inflation is low enough, then demand actually starts to decrease, not increase, which means that the demand curve should look like this. The way the textbook approaches this is that it says, well, that this point here is to do with the zero lower bound. How so? Well, suppose you're cutting interest rates with your monetary policy, and eventually you get to some point where this is now zero. It can't go any lower, right? That's whole zero lower bound. So what it means is, and I guess this is maybe an easier argument to make than the first one, for any inflation below this level, below where you've hit zero interest rates, any inflation below that necessarily means that real rates are rising, because that interest rate, this nominal rate, is just stuck there. It can't go lower. And so again, below that, the real cost of servicing any debt, whether it's old debt or new debt, goes up, and thus below that level, lower inflation is related to lower spending. So you may remember that from last week. The problem is, how does that change? How does that change our understanding? How would that impact our understanding of how this model economy would work? And that is the part that I didn't discuss last time. So here I've represented this economy as being stuck in a, this is a recession, right? We're somewhere below potential GDP. And, well, the way I've drawn it, whether there's this kink here, whether the aggregate demand curve bends or not, is irrelevant if the aggregate supply curve is at this point, right? But so now, if the Fed were to successfully conduct some sort of monetary policy, then of course the demand curve would move back there, right? And again, we wouldn't need to worry about this. But suppose the Fed doesn't do anything. What happens in general if the Fed doesn't do anything? Well, in general, if the Fed doesn't do anything, this level of expected inflation here would no longer be reasonable, right? We would have figured out inflation is going to be lower than we had expected. It's going to be lower for a while. We're observing that the Fed isn't doing anything. So what should we expect going forward? Lower expected inflation. And so this supply curve would move down or to the right, right? If you expect less inflation, then where the wages are lower or they're not growing as quickly, so that increases the supply curve. And now let's draw this supply curve increasing. This is in response to the so-called self-correcting mechanism. What's the problem here? If the supply curve is increasing and the demand curve has this kink because of the zero lower bounds, if the demand curve has moved, if the recession is bad enough, let's put it that way, then the so-called self-correcting mechanism in this economy is not functioning to bring us back to equilibrium. It's actually making matters worse, because it leads to debt deflation, which makes aggregate demand decrease, not increase. And so with this zero lower bound, you can find yourself in a situation where the economy is kind of spiraling down out of control, which means two things. One, this situation where the self-correcting mechanism makes matters worse rather than better means that it's imperative to try and stay away from this kind of deflationary situation, which of course means that we really hope that there must be some ways in which monetary policy can work that don't just involve interest rates. And so that's the last thing we need to discuss today, which is what ways might there be in which the Fed is able to stimulate spending even when interest rates are stuck at zero. Okay, so that's our last task. And to do that, we need to remember that anytime the Fed is doing anything with monetary policy, let's say they're trying to lower interest rates to stimulate spending, how does the Fed actually achieve these lower interest rates? Do they just wave a magic wand and interest rates drop? Of course not, right? Whenever the Fed lowers interest rates, it has to be doing so because it's buying some kind of asset. Or to put another way, the Fed is always supplying more reserves to the banking system. And that's true regardless of how it is that the Fed is doing things, right? So if they're trying to lower the Fed funds rate, it's because they're increasing the supply of reserves. If they're lowering the discount rate, that goes hand in hand with providing more borrowed reserves. And if it's changing the interest rate on reserves, same thing. It's generally doing that and providing extra reserves to the banks at the same time. So that means there's a whole other set of channels of monetary policy related not to the interest rates, but through the provision of more funds to the banking system. And this is the text's key argument. This is something that they think is very important. If just the Fed providing more funds, providing more credit to the economy, directly or indirectly, is a channel of monetary policy, it must mean that for some reason the financial system itself wasn't willing or able to do that, to provide that lending, which means that there must exist serious financial frictions in the world that the Fed can alleviate through its monetary policy. And this is the emphasis of chapter 15, that and I guess of the whole textbook, right? The idea that there is this serious asymmetric information problems out there. The financial system tries to deal with them, and the structure of the financial system is given by the presence of the financial frictions. And these can get worse, especially in bad economic times. So let's think about these, and then we'll be done. So let's think so as discussed, whenever the central bank is trying to lower interest rates, simultaneously they're also providing reserves to the banking system. What does the bank do with these extra reserves? At least to some extent, at least compared to what they would have done without these new reserves, they're lending more. So there's not just a lower price for loans, there's also a larger quantity of them available, which, as discussed, could increase both consumption and investment. And again, this is not through making the loans cheaper, it's by making them more available. And if that Fed is able to do that, it means there must have been some kind of frictions that made it harder for the banks to do that themselves. It could be as simple as the banks decided that it was a very risky bad time, and so they needed a larger number of reserves to um, to feel safe. And if the Fed hadn't provided them, then interest rates would have risen, loans would have contracted, and things would have gotten worse. So what the Fed does is just provides extra reserves, and it lowers those financial frictions. Okay? Now, the next few channels I'm going to mention are a bit more explicitly about the kinds of frictions that the textbook has in mind. So let's consider not the fact that the banks are just lending more, but let's consider the following. What the textbook emphasizes, remember, about financial frictions, whether it's adverse selection or moral hazard, is that they're always worse in bad times. So let's say in good times, you don't have to worry about whether or not someone is going to break a contract. Whereas in bad times, you might be dealing with someone who isn't telling you about their financial difficulties, right? And may not be upfront about what they're going to do with any funds that you give them. I experienced this. My household, some years ago, we bought some furniture, and the company that we bought the furniture from delivered some of it and then went bankrupt and never delivered the rest and never paid us back because they're bankrupt. And so that can happen at any time, of course, but it's much more likely to happen at in bad times because there are just more companies or individuals out there who are in difficulty, which means that in those times there should be decreased trust, much more concern about asymmetric information, and those are financial frictions. So one idea, one channel is what the text refers to as balance sheet effects, because a balance sheet is where you can see whether a company is in trouble or not. Remember, there is here's a quick balance sheet, and again, companies have balance sheet, not just banks. The key is that if you're a bank, then your assets and liabilities are almost all financial, right? You have a bunch of loans, deposits, and so on. These are all financial assets. But if you're a real company that produces, I don't know, jasmine green tea or cell phones, your assets aren't financial. I mean, you may have some financial assets, but your main assets are going to be real, like actual machinery, actual furniture, buildings, and so on. Whereas your liabilities, of course, would be things like loans you took out, and so those are actually financial. And then the difference, of course, is the capital, the value of the firm to its owners. So as discussed, either by making more loans available or by lowering the cost of borrowing, the Fed's monetary policy, stimulating monetary policy, would lower the burden of loans and other liabilities that a firm might have. Whereas the real value of its assets, well, these are actual physical machinery. They're not directly affected by financial conditions. And so what this does is raise the value of capital across the economy. And the key thing about this, according to Michigan, the textbook writer, is that this means that asymmetric information about firms in the economy in general should decline, which increases trust among the companies, between companies and banks and so on, and might ultimately then result in there being more lending. Banks more likely to lend to a company if it thinks that it's not going to go bust. And according to Michigan, a key thing that the Fed does when it supports the economy is it's improving confidence, thus allowing there to be more lending. Another slightly different but similar effect is that, of course, when the Fed is supporting the economy, the firms are just doing better. They're just generating more profits than they would have otherwise. So they're just getting more profits. And again, the more the companies are doing well, the less asymmetric information there is about people you're dealing with, because the likelihood that you're dealing with someone who is in financial trouble and is either going to be either unwilling or unable to complete a contract with you, that likelihood declines. And again, that should stimulate more spending, more lending, and so on. And finally, I guess there's nothing special about firms there, right? What about cash flow to households? Same thing, right? If the households are doing better, again, there's less likelihood that they're going to default on any loans that they might take out. So business partners, banks, and so on can deal with them with more confidence, and that itself should stimulate lending and thus consumption and investment. All right, so that's a lot of different channels of monetary policy. The key is that, again, not all of them rely necessarily on the ability of the Fed to lower interest rates. And that's key because, of course, we are at the zero lower bound. Yet the Fed is still able to, so it seems, provide some stimulus to the economy through all these other effects. Any questions, comments about these possibilities? And again, they're all fairly intuitive. The key thing is at the end, this textbook heavily emphasizes what they view as being the fundamental problem with the economy, which is asymmetric information. Balance sheet effect, again, the idea is that your liabilities are nominal if you're a company, but your assets are real. So when the Fed stimulates things, it lowers the burden of your liabilities because you don't have to pay. Let's say if there are loans there, suddenly the cost of paying them is lower. So you get to accumulate more cash, which I guess you could also say that extra cash that you don't have to spend paying loans also ends up being an asset. So either way, your bank capital increases. And and again, the key step for Michigan is that lowers asymmetric information. Okay? Any questions, comments, doubts? Well, if not, then it's time for our exit quiz. We're almost running out of time, actually. Let's go. 3, 2, 1. First question. What is one reason low interest rates increase the aggregate demand curve? Out of these, they stimulate investment, decrease consumption. That's right, they stimulate investment. Very good. What is another reason low interest rates increase the aggregate demand? That's right, they make it easier to buy durables. Question 3, if expected inflation increases, how might that increase the aggregate demand? It lowers the real cost of new debt, or is it outstanding debt, or is it nominal? Which one is it? It lowers the real cost of outstanding debt because higher expected inflation means lower interest rates, lower real rates on outstanding debt. So what is Tobin's Q? Is it a line of people outside Tobin's pizza parlor? Probably not. It's something to do with share prices and the cost of capital, but what is the equation that defines it? Very good. Everyone got it right. Excellent. Next, if low interest rates increase share prices, what does this do to investments? Does it rise or drop? And what does it have to do with old firms versus investment in new firms? This one's a trickier one. Investment increases because it's better to invest in the new than in acquiring old. What is the credit channel of monetary policy? The Fed raises interest rates to curb lending, the Fed lowers rates to curb lending, or the Fed increases or decreases reserves? Which one is it? The Fed increases reserves, which promotes lending. Next, what is an example of a wealth effect of monetary policy? Number 8, this is a wealth effect. Lower rates may raise share prices. That's right. And shares are a big part of some people's wealth. 8, what is another example of a wealth effect of monetary policy? If it's not shares, what could it be? That's right. Low rates raise housing prices. Good job, Lisa. 9, what happens to monetary policy if we hit the zero lower bound? Credit channels may still work, is the answer. So we're not hopeless. 10, how come low interest rates can increase exports? All right, the currency loses value, which makes exports look cheaper. Next, how come low interest rates can decrease imports? You can leverage your answer to the previous question to answer this one. That's right, the currency loses value that makes imports from abroad look more expensive. Excuse me. Textbook thinks monetary policy works by reducing financial frictions. True or false? It is true. That is their big thing. 13. True or false? The textbook thinks the key friction is asymmetric information. It is true. That's their whole thing. 14. Low rates make borrowing cheaper but don't affect the value of real assets. This is the what? The balance sheet effect, the baking sheet effect, the bed sheet effect, or the real sheet effect? It is the balance sheet effect. Next, what is the zero lower bound? Is it when the growth rate is zero, when inflation is zero, when real interest rates are zero, or when nominal rates are zero? Ooh, it's when nominal rates are zero, folks. Gotta review that one. What is so perilous about the zero lower bound? It's the self-correcting mechanism making things worse because the supply curve moves down and the demand curve is bending away. Almost there. If we take the zero lower bound into account, what is this figure? What does this line represent? The one with a little kink in it. It is the aggregate demand. And finally, according to theory, what happens in this situation if the Fed does nothing? Which curve shifts and in which direction? It is that the SRES shifts to the right and makes matters worse. Let's see, how did we do? Third, we have Alexandra C. Second, we have Sophia. And first, we have Marshall. Again. All right. Okay, everyone, what should I do with Snapchat today to end our class? Marshall?
I'll let my colleague take it. I've done it a few times.
Okay. Number 2 was Lisa, I think, right? No, Sophia.
I actually did it last time, so I don't know if Alexandra wants to do it. If she doesn't, then I can come up with something.
All right. Alexandra?
Maybe a bunny, like a rabbit.
A bunny. Let's see. There we go. How is that?
That's perfect, thank you.
Okay, great. All right, everyone. Oh, wow, it even has bunny teeth. This one's pretty good. All right, everyone, take care. Talk to you in office hours or in class on Wednesday. Meanwhile, take care and stay in touch. Bye.